Hello and welcome to the Business Standard Morning Show. I'm Veenu Sandhu. Let's take a look at the stories for the day. The collapse of the Silicon Valley Bank, or SVB, is the biggest US bank failure since 2008. This might make it look like a repeat of the Lehman Brothers collapse, which had triggered the 2008 global financial crisis. Banks across the globe might already be feeling the heat of SVB's failure. So, what domino effects will the Indian banking system witness? While a number of Indian tech startups have reportedly been affected by the crisis, what are the chances of a broader contagion reaching our shores? Bhaswar Kumar and Raghav Agarwal bring you the answers.
On March 10th, US regulators shut down the financial partner of the innovation economy, as the Silicon Valley Bank called itself, after it suffered a swift collapse. The development sent shockwaves across the global tech and banking industries, stranding billions of dollars of deposits and roiling global markets. The Santa Clara headquartered lender, which catered to startups, venture capitalists, and tech firms, was the 16th biggest bank in the US before its collapse. SVB was also the second US bank after Silvergate Capital that collapsed last week. The crisis didn't end there. Banking regulators shut down New York-based Signature Bank on March 12th, making it the third bank to close its doors in a week. Apprehensions of a contagion emerged because the SVB crisis was the second largest bank failure in the history of the US and the first such incident after the 2008 depression. Before this, Washington Mutual Bank had collapsed in September 2008. It had assets worth $307 billion and deposits of $188 billion. SVB, just before its collapse, held assets worth $209 billion and deposits of $175 billion. Meanwhile, the Signature Bank failure was the third largest in US banking history. On March 12th, Finance Ministry officials told a national daily that any broader contagion effects that may arise from SVB's failure would not reach the Indian banking system anytime soon, and they were unlikely to trigger any systemic risks. The government reportedly didn't expect any major effects to spill over to the Indian economy for a while. SVB's collapse was triggered by the impact of rising US interest rates on past government bond holdings. With its customer base concentrated among cash-rich American tech startups, SVB didn't have many avenues to make money by lending. Thus, the bank reportedly invested about $88 billion in mortgage-backed bonds in 2021. But the value of those bonds collapsed as the US Fed rapidly increased interest rates. This eroded SVB's capital base completely. At present, the Indian government and financial regulators are reportedly keeping a close watch on how the situation develops. The Macquarie Group also told Bloomberg that the significant reliance of Indian banks on local deposits would provide them a cushion, even as their global peers faced potential contagion from the Silicon Valley Bank crisis. According to Macquarie analyst Suresh Ganpati, amid all the gloom and doom in global lenders, Indian banks stood out with hardly any direct or indirect exposure to SVB. So, is the SVB crisis a Lehman moment?
It's too early to kind of draw to those kind of inferences and conclusions. My sense is basically as we see situation develop and as we start analyzing more incoming data out of it, we will probably come to some amount of analysis saying that how it can probably pan out.
And is there a possibility of contagion risk to Indian banking in particular?
So there is no likelihood of any contagion effect of SVB failure, primarily because this failure is due to asset liability mismatch, which could be resolved by the regulator there easily. Indian regulator is very active in that, and they have already a number of windows for any such cases. Now, last time when it happened because of bad assets or the subprime assets. Now, that's not the scenario here. So I do not think any possibility of any contagion.
Also, what data points should the authorities continue to monitor?
The key monitorables is basically the chain reaction, probably whether it is kind of there, how many people are affected with this, and you will have to kind of get those kind of data, whether this is kind of seeped in, system wide, or whether it is just kind of pretty shallow. So all of these things are kind of yet to be analyzed.
Analysts at Nomura have said that the US Fed may not pause its rate hike cycle despite the developments at the Silicon Valley Bank and Signature Bank. Meanwhile, government officials have reportedly said that if either higher interest rates or a possible SVB contagion hit more foreign lenders, it could lead to a flight to safety among global investors. This could affect capital flows into India and impact the rupee.
So if US Fed and European regulators, they increase rates, they enhance rates, certainly India will have to increase rates. Otherwise, capital will fly from here, because ideally the differential has to be 3.5% or 3%. The moment this differential is not there, then you start having the rates, the capital moving from here, unless we also increase rates commensurately.
On March 13th, a joint statement by the heads of the US Treasury, the US Fed, and FDIC said that the FDIC would complete its resolution of the Silicon Valley Bank and Signature Bank in a manner that fully protects all depositors. It added that no losses would be borne by the taxpayer in both cases. Meanwhile, US Fed Chair Jerome Powell's hawkish comments in his recent testimony to the US Congress have left investors expecting a 50-point increase in rates at the upcoming policy meeting. Going forward, lenders and regulators across the world will keep a tab on how things progress on both these fronts.
Investments worth $700 million and 100,000 jobs. These are the ambitious numbers that Apple has lined up for India. The tech giant has also changed its internal structure to focus exclusively on the country. The iPhone maker is no doubt highly optimistic of its growth prospects in the country as it plans to shift away from China. Tushar Verma explains why Apple is so upbeat about India.
Apple Inc. is making headway into India's manufacturing pipeline. Commerce and Industry Minister Piyush Goyal said in January that Apple is targeting up to 25% of its manufacturing in India. While the minister may have been a bit too optimistic, he was not far from reality. Foxconn has invested $700 million in Karnataka and plans to set up an iPhone manufacturing facility near the international airport in Bangalore. The Department of Industry and Commerce of the Karnataka government said in a tweet that this investment will generate about 1 lakh jobs. According to a Bloomberg report, 3 key Apple suppliers, Foxconn, Wistron and Pegatron, will together manufacture and supply at least 20% of Apple's global iPhone production from India. It is expected to be achieved by 2026. JP Morgan Chase, on the other hand, has estimated that the tech major will make a quarter of all its iPhones in India by 2025. So, why is Apple so bullish about India?
Apple sees India as a larger and larger market. We have more and more affluent consumers who can afford Apple products. In terms of supply chains, Apple has very consciously decided that it needs to diversify away from China. India is a very good place for it to diversify, both through its old contract manufacturers, 3 Taiwanese firms that were its big contract manufacturers, and they're all setting up operations in India. And also Tata Electronics, which has set up a plant specifically, specifically to cater to Apple's demand. So that's all very positive. And I think both from the demand side and from the supply side, we will see a greater and greater presence for Apple going forward.
If you see, there are a lot of luxury brands and premium brands that are increasing their sales in India, increasing their base in India. and we are seeing very high 100% plus growth figures in these premium brands. So now connecting it to the electronics industry and more specifically the smartphones industry, if you look at Apple, that itself has grown, iPhone sales in India almost 4 to 5 times in the last 4 years. So looking at those trends, I'm not surprised at all that they are bullish on the Indian market, and with the Chinese market stagnating, and then the European markets also, maturing and with an aging population, here what we are seeing in India is an absolute exponential growth prospects for the retail and the luxury brands.
Apple's increasing focus can also be seen through its internal management changes. Hughes Asseman, Apple's vice president in charge of Middle East, Mediterranean, East Europe, and India, recently retired. Now, Ashish Chaudhary, head of Apple India, has been promoted to report directly to Apple's head of sales. This shows Apple's focus on India as it is not clubbed together with other regions. Sales of iPhones in India soared even when global sales of the device dropped. This is another reason which underscores India's growing importance for the tech major. One of the steps towards this is the $700 million investment in Karnataka. But why did Apple choose Karnataka out of all the states?
So first of all, I think the states that have been chosen, for all the investments, they all tend to be in the south of the country for a very simple reason. We tend to have, I think, a more disciplined workforce. We tend to have better infrastructure. We tend to have probably a more skilled, generally both a skilled labor force from the point of view of engineering and a more skilled labor force and disciplined labor force from the point of view of the shop floor workers. So from all those angles, the South has made more sense. In terms of this specific investment in Karnataka, Karnataka has also, as you know, announced a change in its labor laws, specifically to address the demands and needs of Foxconn, and in particular to provide much greater flexibility in terms of shift work and also becoming more flexible in terms of women's employment. That's again something that we should really be enhancing. We have really very limited, very low labor force, female labor force participation ratios in the country.
One of the key reasons behind Apple's optimism towards India is the growing demand for devices and services. However, experts have expressed concerns that this increasing demand is largely coming from the affluent class, while there is no significant increase from the lower economic strata. Another important aspect in India is the change in labor laws. While critics may argue against the increased limit of working hours, experts say that the changed labor laws will increase female workforce participation.
More than 2 months into 2023, the equity markets continued to remain subdued. The US Federal Reserve and the Reserve Bank of India also remained data dependent in the resolve to tighten the policy rates further. Against this backdrop, should investors shift their focus from equities to debt? Puneet Wadhwa brings you the answer.
Renewed fears of aggressive rate hikes by the US Fed in the backdrop of the recent macroeconomic data could see the Indian equity markets remain range-bound amid volatility over the next few months. This comes as the possibility of El Nino also risks stoking inflation back home and could prompt the RBI to continue with its hawkish stance. This, analysts believe, presents a good opportunity for investors to shift their focus from equities to debt.
When you look at broad markets and look at the scenario at this moment, it being an interest rising regime, in such a scenario, it becomes difficult for equity markets to get re-rated. No doubt, Indian data points are strong, but in a rising interest rate regime, there is that much that can happen to the equity market. So we do look at the equity markets to remain more or less sideways for this financial year, unless there is some trigger which comes in globally, which does not look likely looking at the similar data points globally. I mean, some of the data points from US are not exactly very strong, and their interest rates suggest that it is a 4-decadal high, and the impact of that will take some time to not only smoothen out, but to reverse. In that scenario, I feel investors are in a good state because the debt side of the market gives them some fantastic yields to lock in. And the equity market, when you look at projecting India over a period of 5-10 years, is definitely headed to go from 2.5-3 trillion to 6 trillion. And at this point, the global markets also look attractive. From an investor perspective, it's a good time for long-term investors to dig in and accumulate. And the debt side of the market is giving them fairly good opportunities from locking into some very decent yields at this moment.
US Fed Chair Jerome Powell recently said that the Federal Open Market Committee, or FOMC, is likely to take rates higher than previously anticipated as he left the door open for a 50 bps rate hike later this month. Last week, the non-farm payrolls in the US increased by 311,000, higher than the expected 205,000. This has put fears of a higher than expected rate hike by the US Fed back on the table. As per Philip Murray of Rabobank International, if longer-term interest rates remain too low to slow down the economy and squeeze inflation out of the system, the federal funds rate may even have to go higher than most of us can currently imagine. Meanwhile, returns from the Indian benchmark indices have been dismal so far in 2023. While the BSE Sensex has slipped around 2%, the Nifty 50 has lost nearly 3% in calendar year 2023. Amid the uncertainty, experts say that investors can also look at investing in both debt and equity segments. Markets are pricing in a 50 bps rate hike in the next Fed meeting. Investors may adopt a twin strategy of attractive fixed income returns with incremental investable funds while continuing to buy high-quality stocks on market weakness. Therefore, investors should remain stock selective and can also look at the debt segment as the equity market could witness heightened volatility ahead amid fresh risks of longer than expected rate hikes. On Tuesday, the markets are likely to remain cautious ahead of the CPI inflation print in the US, which could reaffirm Fed's resolve on rates.
To protect investors' money during events such as the collapse of the Silicon Valley Bank, governments and central banks across the world have a provision of deposit insurance, which protects your deposits. Now, how does deposit insurance work when a bank collapses? Raghav Agarwal explains.
Deposit insurance is the cover provided to deposit holders in a bank when it falls and does not have enough money to pay back the depositors. It is provided so that the depositors do not lose all their money during a crisis. Different countries have different bodies that handle this insurance. The US was the first country to introduce this way back in 1933. Interestingly, India was the second country to launch it in 1962. In the US, deposit insurance comes under the ambit of the Federal Deposit Insurance Corporation, or FDIC. The banks have to register under the FDIC, and it protects deposits up to $250,000 per depositor per insured bank. In the case of SVB, reports suggest that 93% of deposits were uninsured. But on Sunday, the Joe Biden administration said that the resolution of the bank will be done in a manner so that it protects all the depositors and they will get access to all of their money from Monday. In India, insurance cover is provided on deposits up to Rs 5 lakh. Before February 2020, the amount was Rs 1 lakh. The deposit insurance here is provided by the Deposit Insurance and Credit Guarantee Corporation, or the DICGC. All the deposits like savings, fixed and current are insured under the scheme, and all the commercial banks and cooperative banks are insured by DICGC. If the deposit in a bank account is higher than Rs 5 lakh, the deposit holder is only liable to get Rs 5 lakh. They will not get the excess amount. But if they have two different accounts in the same bank, the Rs 5 lakh limit will be applicable to both the accounts separately. I will achieve, I will fly high, I am the I in
nation's trusted bank, SBI, the banker to every Indian.
Argentina had abolished deposit insurance from its financial system but reinstated it in 1995. That's all for today. For more news and analysis, please log into our website business-standard.com. And we'll be back tomorrow. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.